Hello everyone, my name is Moji. You're watching a Bitcoin bubble news channel. On the other hand, all that negative equity is leaving the Fed and going into the commercial banking system, which means that the commercial banking system is being paid pretty well. So they're actually doing pretty well with those liabilities, those higher yielding liabilities from the Fed that are paying out to banks. This means that banks are getting paid to do nothing, so they don't mind. Lyn Alden is a well-known and respected financial analyst, researcher, and writer who focuses on trading and macroeconomic trends. Forbes, Bloomberg, and the Wall Street Journal have all written about Lyn because of how well she knows how to do study, analyze, and talk to people. She has a famous website about investments where she talks about and analyzes many different financial topics. In this video, she shows off her investment portfolio. Lyn talks about the banking system, especially the fractional reserve system. This system lets banks make money by lending out the rest of their deposits and leaving only a small portion of their deposits in reserve. Lyn also says banks make too much credit, which she says leads to inflation and asset bubbles. In her book Financial Bubbles and Instability, she talks about Bitcoin's payment and how, when widely used, its fast network and ability to grow will put banks out of business. She also talks about central banks and how they are different when it comes to bank runs and other risks that private banks face. This movie shows you everything you need to know about how banks work. Leave a review and subscribe. In recent times, this is the first time. Wow, some of them were the same in, say, the 1940s. But this is without a doubt the first time it has happened in recent times. For about 40 years, things have been getting worse, which is why it happened. So they never raise interest rates so sharply that the interest rate on their debts is higher than the interest rate on their assets. But in 2022, they raise interest rates so quickly that the interest they pay on bank savings and reverse repos is higher than the interest they earn on their treasuries and mortgage-backed securities on average. The Federal Reserve now has a running loss instead of an operating income, which means that if they were a normal bank, they would be close to going bankrupt right now. But they're not like that because they're a central bank. One reason is that the way their paperwork is set up means that having negative equity doesn't have any short-term effects on them. Because that's how the Federal Reserve's books work, they're running the loss right now. They no longer have money to send to the Treasury because they aren't making any. Then, though, what they're really doing is taking away their wealth. But instead of going market to market and saying, okay, we're getting close to negative equity, they give themselves an asset. You could say it's a delayed asset, which means that if they ever make money again, they get to pay themselves back first. They have a chance to get out of this mess before they have to give back their extra gains to the government again. So it's kind of like if you owned a business that was going bankrupt and said, well, there'll probably be a time when I'm not bankrupt, and so, you borrow money from the future and promise to pay it back when that time comes. The Fed is getting close to negative physical equity, which is kind of the same thing. But unlike a normal bank, when they hit zero, there are no instant consequences, at least when they move below zero. So the big difference is that they can still do business. And that's actually what will happen to the Treasury. The government has lost a $100 billion source of income. And even if the Federal Reserve starts making money again in the future, that source of income won't be used for a long time because the Federal Reserve would be fixing its financial problems before sending more money to the Treasury. In other words, the Federal Reserve can do what it does because most of the time the results don't help them. They're on the Treasury and the taxpayers instead of them. Now, if this goes on for long enough and to a big enough degree, you might start to doubt the independence of the central bank. Okay, because that's a different situation if you're legally bankrupt. But at this point in time, that's a very, very long way off. There aren't many penalties for them. Instead, the Treasury has to deal with the fallout. Lyn looks more deeply into the central bank, looking at its rules, how it works, and why it is less likely to have problems like bank runs than other private banks and financial institutions. The problems she finds are not as bad. That's why I wrote this article a few weeks or months ago. I started to see these doomsday charts. This is especially true because the St. Louis Fed's charting system isn't very good for this measure. It looks really bad. That's why a lot of people are tweeting about it. Thus, I was moved to write an article in order to explain this strange figure that I keep seeing being passed around. In short, this won't cause anything to explode. Okay, they don't run into any short or medium-term problems by doing this. Instead, one of the main effects is that budget deficits will be bigger now that that $100 billion source of income has gone away and probably won't be coming back anytime soon. So that's about the same amount of money that 4 NASA spacecraft cost. Okay, people today think that $100 billion is a small amount of money. On the other hand, NASA is about 25. Yes, 25. The US. Government lost a way to make money. In fact, that's one real effect of this. However, the commercial banking system is basically getting paid pretty well because of this. This is because all of the negative equity is leaving the Fed and going into the commercial banking system. In fact, they're doing pretty well, I should say, that those higher yielding loans from the Fed are paying out to banks. In other words, banks are getting paid to not do anything. They don't mind what's going on. Longer term, it's possible that someone like Senator Warren or others will either say that the Federal Reserve is paying banks too much, or that people will ask, hey, why do you have this much negative, tangible equity? Does that make your central bank less independent? So some of the long-term effects can get worse if some of the Fed's moves become even more political than they already are. The costs could be cut, but they're not going to. Instead, they will basically release an extra $100 billion worth of Treasury securities. Because of this, the debt will grow faster than it would have if this hadn't happened. Also, the fact that these higher interest rates on debt are making more debt is making things even worse. So for example, if they were spending $400 billion a year on interest when interest rates were lower, they are now spending around $800 billion a year on interest when rates are higher. That level might not be enough. Now they're not, cutting something to pay for that. To pay for that, they're just putting out more notes than they normally would. To hide the fact that their interest rates on their debt are going up and they just lost a source of income, they're basically taking on more debt. And I think that shows up in the form of inflation in general. One thing I'd like to point out is how different it is from 2008. In 2008, banks were in danger because of a collapsing economy. There are a lot more claims than base money, so there was a chance that everything would fall apart. I now think that long-term inflation is the biggest risk. Because of these forces, the inflation rate will tend to rise. This doesn't mean that the rate can't go down briefly, but it does mean that the bias is up. So unless it's being held down, it's ready to keep coming up or being a problem. Something else way to look at it is like how everything is a stacked layer or ledger. Okay. We have bank accounts, so you know that. They keep their money in central banks, which back up their assets with things like government bonds. There are also times when bailouts happen higher up. Such as, in the 1990s, there was long-term capital management, a big hedge, a big giant leveraged hedge fund that went bust. The Federal Reserve bailed it out. For some reason that helped cause the dot-com boom that burst. After that, interest rates were lowered, which led to a big house bubble. And when that finally happened, the private sector didn't have any more weapons to use. The Ponzi scheme started to spread from one person to another. They basically put debt from the private sector on the balance sheet of the state sector. In the end, it all ended up on the Federal Reserve, or more often in government savings and debt. Now we can see that all of that is held up to the level of the sovereign. All of the debt goes up very high. From there, the only place to kind of let it go is onto the currency. Okay. With this, the value of the currency